In the traditional financial system, every transaction depends on a central intermediary. Banks and clearinghouses serve as the ultimate authorities, maintaining the ledgers that track the ownership and movement of capital. This model assumes that these institutions will remain solvent and honest. However, a system built on centralized human trust is vulnerable to institutional mismanagement, accounting errors, and systemic collapses. The 2008 financial crisis served as a demonstration of these vulnerabilities. When the world's largest banks could no longer verify the value of their own assets, the trust required to maintain the global ledger evaporated. The events of 2008 suggested that the primary risk in legacy finance was not a specific economic policy, but the structural necessity of relying on fallible human organizations to manage the truth of the financial record. While the banking system was reeling, an anonymous figure using the name Satoshi Nakamoto released a technical white paper to a small group of cryptographers. Nakamoto proposed a system for electronic cash that allowed two parties to transact directly with each other. This peer-to-peer design was intended to bypass the need for any financial institution. To make this work, Nakamoto had to solve the problem of double spending. Without a central bank to verify balances, a digital currency requires a way to ensure a user cannot send the same unit of value to two different people. Nakamoto's solution used cryptographic proof to automate the verification tasks traditionally performed by bank employees. This system is built on a blockchain, a public digital record of transactions that is shared across a global network of computers rather than stored on a single server. The ledger is secured by a hash function. This mathematical process takes any amount of data and produces a unique fixed-length digital fingerprint called a hash. If even one character of the original transaction data is altered, the resulting hash changes completely. This makes any attempt to tamper with the records immediately visible to the rest of the network. Bitcoin groups transactions into blocks. Each new block contains the hash of the one before it, chaining them together. This creates a sequential history where the validity of each block depends on the mathematical integrity of the entire previous chain. Because the hashes are interlocked, changing a past transaction would require recalculating every subsequent block in the chain. This mathematical structure replaces institutional trust with independent verification. The ledger is maintained by a decentralized network of independent computers, known as nodes and miners. To add a new block to the chain, miners must participate in proof of work. This involves expending massive computational energy to solve a complex cryptographic puzzle, ensuring that participation in the network requires a real-world investment. Once a miner solves the puzzle, other nodes on the network can instantly check the math. If it is correct, they update their copies of the ledger simultaneously. This process uses the consumption of electricity to protect the network. It ensures that no single entity can dominate the ledger without controlling more computing power than the rest of the global network combined. Most traditional currencies have an elastic supply managed by central banks. In contrast, Bitcoin's issuance is governed by a fixed, unchangeable code. This chart shows the projected supply curves for both systems. While fiat currencies can be printed indefinitely, the Bitcoin protocol limits the total number of units that will ever exist to 21 million. The protocol manages this scarcity through a halving event every 4 years. During this event, the amount of new Bitcoin awarded to miners is cut in half, reducing the rate at which new units enter circulation. This supply schedule establishes a digital commodity with a predictable issuance, providing an alternative to assets managed by discretionary central bank policies. In its early years, Bitcoin had no market price. The first recognized exchange of the asset for a physical good occurred in 2010, when a programmer traded 10,000 Bitcoin for 2 delivered pizzas. Over the following decade, the narrative surrounding the network changed. What began as an experiment for software developers attracted a wider range of investors who viewed its fixed supply as a hedge against inflation. This trend reached a new stage as publicly traded corporations and certain national governments began adding the asset to their official reserves. In 2024, the financial landscape shifted again with the approval of spot Bitcoin ETFs. These products allow traditional investors to gain exposure to the asset through the same brokerage accounts they use for stocks. The launch of these regulated instruments connects the protocol to trillions of dollars in traditional capital, situating the ledger alongside established financial assets in the global market. Despite its institutional growth, Bitcoin remains a highly volatile asset. Its price is subject to large swings, driven by market sentiment and shifting economic conditions. The network also faces ongoing challenges, including varying regulatory approaches by different governments and debates regarding the environmental impact of its energy-intensive mining process. Throughout these external pressures, the protocol has continued to operate according to its original design, maintaining a history of consistent network uptime and resistance to unauthorized changes. The network provides a technical framework for achieving global financial consensus without the oversight of a centralized intermediary. 15 years after its inception, the protocol's fixed mathematical rules continue to operate within the volatile and unpredictable environment of the global economy.